Hi, my name is Laurie Wolf. I'm a certified global business professional, and I've been an economist for more than 30 years, teaching everyone about economic principles and international trade. I look forward to speaking with you at IWF Atlanta about growing your business through exports and new markets that you might be able to target. But for today, we're going to focus on the extraordinary economic times that we're living in and also the extraordinary measures that the government is taking to try to stabilize the economy. So the main stimulus package is known as the CARES Act, and it was passed towards the end of March, and it had a number of components. So one of the important components was called the Paycheck Protection Program, and we'll talk about that in more detail, but the idea of this funding was the initial funding has basically run out and was pretty much exhausted within 10 days. And it didn't go out necessarily how they wanted to. So as we talk about this program now, we'll kind of go through some nuances and what kinds of things, the changes the government is making. There are also through the SBA, these emergency loan advances, which were too quickly exhausted. And then the SBA always has ongoing lending programs, including programs for exporting that I like to talk with firms about. And so those other SBA loan programs are still there. And there were some special protections for those loans where people got to defer payments and where people got to have more generous terms and things like that have happened within those programs. So the other SBA lending programs also had some special exceptions within this act. There were payroll tax credits. So for people who don't take any of these loan products that are coming from the SBA, if you continue to make payroll, you can get a $1,000 per worker tax credit towards your payroll taxes up to $10,000. And if you are making payroll right now, you can defer payment of your part of the payroll taxes to 2021 and 2022. So those are things that are going to help increase people's cash flow. They made changes to IRA withdrawals. The issue with that right now is that the stock market isn't in such great shape. So depending on how your IRA was invested, it may not be a good time to tap your IRA for funds. But for people who do tap their IRAs, they have repayment provisions, but also they have waived the penalty on early withdrawal of those IRA assets. For situations where you've had to furlough workers, perhaps because you're shut down and you literally can't operate, they've added $600 extra in unemployment benefits to whatever state benefits are available, and those are being paid by the federal government. And for the first time, independent contractors and workers who are temporary workers who are not normally covered by unemployment programs are eligible to receive at least the federal portion of the benefit, so they are able to apply for unemployment. So those are all efforts to try to stabilize payrolls, kind of move us on so that we can get to a future where things are back open and regrouped. So the Paycheck Protection Program was very popular because it was a loan that basically became a grant. It could be forgiven, and it was based on maintaining your payroll. So the funds were exhausted, I think, within 10 days of when the program launched. It was an extraordinary effort. In normal times, the SBA makes something like $30 billion in loans a year, and they work with some financial institutions. This program was over $300 billion and was all kinds of lenders coming into the program. And so it was very quickly implemented. It was very quickly exhausted. And there's a lot of questions now about how some of those funds were spent, and I'm sure you're following that in the financial press. So the reason it's so attractive is that even though it's a loan, the loan will be forgiven if 75% of the funds are used for payroll. So you have to use them over an 8-week period. That time frame may be extended. It initially started at the end of February and went to like the end of June in that time period. So people who laid off workers could rehire them based on getting these funds. People who maintained payroll could get loans based on maintaining that payroll. And so you could get funds not just for payroll, but also that could go to rent, utilities, and other business expenses. But basically, the forgiven part of the loan would be 75% of that had to be based on payroll. It tended, because of how it got implemented, banks that were already SBA lenders were able to get those programs up quicker. Larger banks tend to be SBA lenders. Banks basically worked with existing customers before they tried to make relationships with new customers. And so those loans largely went out through the largest banks, largely went out to their existing loan customers, and didn't necessarily get distributed based on the kind of needs that they attended in the program. So one of the things that's happened with this new round of funding is that they're making people make a statement that says we really do need these funds in order to survive. And they're basically saying that any public company, because they can issue stock and draw on capital markets, doesn't need these funds. And so they're kind of encouraging the public companies who got funding in the first round to return those funds. They're basically saying, we're not going to ask you to sign this form too, but if you want to give us the money back instead of signing this form, you have until May something to do that. So they are trying to make the funding go a little bit more where it was intended in the initial phases. And we can assume that, yes, they're doing even more vast amounts. So hopefully the House is approving the second round of funding even as I speak, and it's a little bit larger than the first, and it includes some other things. But we can assume that that is going to get quickly exhausted too. So hopefully you were in line, you were working with the banker, you didn't get funded, but you're at a point where you're approved, but there was no funding left. That's where some of the businesses that I work with were at. And so they are expecting that with this new funding, their loans will get funded. But bankers that haven't started working with people are saying to people, you should go talk to somebody else. So I just saw an article from JP Morgan that they basically looked at their clients and put them in 4 tiers. And if you're tier 1, we haven't even started working with you, we're strongly suggesting that you go see somebody else because we don't think that those funds are going to be available. So if you have an active application, I encourage you to follow up with your lenders. If you think this is a program that would be great with you, you need to get with your lender quickly and get something together for this because, again, the needs are vast compared to the funds that are available. And because of this feature of it becoming a grant, it's really super attractive and competitive, I think, for people to get that. So there's lots of other programs going on. So the Federal Reserve is our central bank, and it was created to stand behind the system in the times of crisis to inject a lot of needed liquidity, and that's really what it's doing. So I realize I teach economics and I'm kind of wonky, but the Federal Reserve is really critical in all of this and plays a big role. And so some of the things that they've already done emergency interest rate cuts, which cut the interest rate back to 0 for the Fed funds rate, which should move all other interest rates lower. They have injected tons and tons of liquidity, more liquidity than they did in the financial crisis. So we're seeing really strong response here. And the good news is that banks, before we got into this mess, we're in good shape. This is not an economic crisis. This is a health crisis that has created an economic crisis. And so the banks were well funded. The banks had a lot of liquidity, and the Fed is making sure that they stay that way. And there were a lot of new rules about how much they could lend in capital. And so it's important for the Fed to be actively engaged with them to make sure that they can keep providing these functions. So the Fed is already buying up all kinds of assets that it wouldn't usually buy. So one of the markets that got in trouble was the commercial paper market. So lots of corporations that have great credit ratings issue commercial paper. These are short-term IOUs, and that's like a routine part of doing their business. Well, that market started to lock up. So the Fed wound up buying commercial paper, saying it would buy commercial paper directly from really creditworthy banks to make sure that that liquidity was still there for business financing. They also have provided liquidity into municipal bond markets. So the Boston Fed is coordinating an effort to provide liquidity because all these state and local governments are clearly having to issue debt in order to pay for these programs to make sure that liquidity is there. So, we talk about the economic stimulus package that came out of Congress. The Fed immediately did something like $2 trillion worth of extra liquidity, and they have in motion things that are like $6 trillion in extra liquidity. So the amount that they're doing behind the scenes is very large. The good news about that is it doesn't raise the deficit or the debt. Very little of that is actually coming from Treasury. It's mostly just extra liquidity to make sure that those assets, can be exchanged, can be sold. Treasury does give some of the funding because the Fed is not supposed to make a loan that loses money. They're supposed to make good loans. And so for something like the payroll protection plan, that's problematic because it's guaranteed that this loan is going to get forgiven. So in essence, Treasury gives some of the money. The Fed, the bank makes the loan, and the Fed buys the loan off the bank's books with the Treasury's part covering the part that's going to be forgiven, in essence, is how that's going to work. So banks that have exhausted their liquidity because they've made all these PPP loans are now going to be able to sell those off their books, get the liquidity back, and then be able to continue working with their existing bank customers. So they just announced, the Federal Reserve, this Main Street program, which is aimed at those sort of mid-sized and large corporations. So the program here would be a direct bank loan to those corporations, and that the Fed would then be able to buy that loan off the books of the banks so that the banks could relend and relend and relend. So they're geared with businesses up to 10,000 employees, less than $2.5 billion in revenue last year. And the principals and interests, they're at nice terms. The principals and interest are deferred for a year. It's a relatively friendly, repayment structure. And so the whole idea of all of this is that underlying our economy was in great shape. We just temporarily are not producing at it. And we want to move forward in time our ability to have to pay this stuff back so that it can come in at a time when the economy is back in good shape again. So the minimum loan size here is $1 million. So that's a larger base, and again, it's intended for larger businesses. And the maximum loan size is either 25 million or some formula of EBITDA that it can be the less, whatever's less. So based on your EBITDA, if you qualified for more, the most loan you can get is 25 million. And the Treasury is, again, giving part of that funding. So the Treasury puts some amount of money up, the banks make the loans, the Fed then buys the loans off the bank's balance sheet so that the banks then have the liquidity again to work with the next customer. And they've made this joint thing to get the pool of funds together to do this. So again, it's an attractive interest rate point, it's attractive payment schedule. So if this is something that suits the needs of your business, the person you're going to talk to is your bank. So banks are making these loans. The Fed is just providing the liquidity behind the scenes and the incentive for banks to be able to do more and more and more. So the first line for you is to talk to your lenders. So in general, when we have time issues, we have the ability to earn revenue in the future, but we have to put the money out now, to be able to do the expenses. That's a loan structure, and you're talking with your financial markets and especially your local bankers. So the kinds of support that the government's giving through both the Payroll Protection Plan and through the Main Street program is to banks. It's to banks so that they will lend to you under better terms, and they'll have more money to lend to you than they would normally have. So work with your banker. So again, I told you, JP Morgan Chase has already said, if you're not our customer and we haven't gotten very far in a loan package with you, you should really go talk to somebody else, because it's unlikely the funds under the Payroll Protection Plan are still going to be here by the time we could process your loan. So whoever you usually work with, whoever's the larger bank in your region or area, that's the place you want to talk to. And if you don't know who to talk to, my strong encouragement would be to talk to your SBDCs, your small business development centers, your economic development officers. There's all kinds of state and local outreach for business that if you need help kind of going through this process, I would really encourage you to turn towards them. You also, everybody's got problems with cash flow. And so talk to the people in your supply chain. If you have an accounts receivable, if you have an accounts payable, you need to be talking to them. It's not a good time to ignore it. It's not a good time to not tell people the kind of situation that you're in and what is possible. So everything is potentially negotiable given the kinds of crisis that we're in. And so for your own planning, you need to know, where the people are in your supply chain. You're going to be able to get those parts because they were able to pay their vendor. Those things matter. So I would be really clear and talk with them. If you are really in tough times and you have to furlough workers, the good news is there are extra benefits than would normally be there for them. And so furloughing is a good way to make it official. I can't employ you right now, and make them eligible for some of these extra unemployment programs. So the baseline of what they're going to get depends on the state that you're in, but all but 44 of the 50 states have now got in place the extra $600 of benefits per week coming from the federal program. So there's a few states that are still trying to get that worked out in their systems, but 44 of 50 have. And that does count on the state offices for unemployment processing being up and ready. And so they've been asked to do a lot. So they weren't ready for this number of workers to be unemployed. We've had more filings for unemployment than we created jobs since the financial crisis. So that is a huge number, hopefully a very short-term disruption, but it's a huge number of people to process. And so states were at various levels of readiness to do that. So the most ready ones, it took them a week or two to get the first people filed, and then it took them a week or two to get the 600 extra in. And we're just now, I will warn you that the numbers for unemployment are, I think it was another 4 million today. It's going to be bad again next week, because we are just now getting at the states that were the most prepared to the point that the independent contractors can file. So they just didn't have that in their systems. And so they're creating that space in their systems. And so some of those states that are on the front edge of being able to deliver that are just now getting it in place so that people can file now. So those numbers are probably going to continue to get worse for a bit. They can be backward though. So if you've had an independent contractor who's been not able to do work for the last 4 weeks because your operation's been closed, that's a person who could potentially backdate that claim to the beginning and be able to get some assistance in that time frame. Some of you have been deemed essential. So you've been a deemed essential businesses. That is a very, I need to write a column on that for IWF, but that is a very political and difficult thing. It's going to be very much based on your state and local governments, and it's going to be based on local needs and your ability to do that. So again, get in dialogue with your local business centers, your chambers of commerce, your economic development offices, talk to your county officials. Those are the kinds of people that you have to have influence with in order to be deemed essential. You can also look at if it's possible to change any of the production that you're doing to something that's considered high need. That would be another way to potentially manage that. So retrofitting spaces, equipment, those are some examples, but even just construction things on health centers. So there's a lot of places that can get deemed essential. And if things are happening outside, perhaps, there can be more opportunities for business to resume. And then I was listening today to some people from the SBA. The normal stuff is still going on. So one of the things that I like to talk with people is about, using these programs to identify foreign markets and expand their business through international trade. Those SBA loans are still there. They're not in these special programs. Those are loans that are out there. So the existing customers still have access to them. They can still do their things. And so if you can kind of take this time in your business to look around and say, what can I do that's going to grow my customers, that's going to grow a niche, that's going to do something for me? Some of those things are still available. Some of those programs are still available, and we can highlight them. But what can I do with these leveraged funds, these borrowed funds I've got, that's going to put me in a position not just to take care of my current need, but to really leverage my future business opportunities? The kinds of businesses that come out on the other side of this stronger and faster are the ones that take advantage of a disruption like this to really lay the groundwork for the next time, the next cycle, the next moment. So I want you to be positive and think about that. So if you have questions, you can reach me through IWF, and I will continue to blog on these and other issues as they come along. So best of luck. This is a time that I think hopefully we can all pull together and cooperate and work to really make sure that we come out on the other side stronger and better. Thanks. Have a great day.